Imagine a world where your money not only grows, but also remains steady, resilient against market storms and economic downturns. Welcome to the world of bonds, a world often overlooked but powerful in providing stability, income, and growth potential. Bonds serve as the backbone of countless portfolios, offering a safe haven in turbulent times and a steady income stream when the market seems volatile. In today's journey, we'll explore the essential concepts of bond investing, how bonds work, the various types, strategies for building a bond portfolio, and the crucial role bonds play in diversifying investments. Let's unlock the potential of bonds and see how they can serve as the bedrock of a robust financial plan. Bonds are essentially loans made by an investor to a borrower, which is usually a government agency or a business. By purchasing a bond, you're lending your money to this entity, which in turn promises to pay you back with regular interest payments and, at the end of the bond's term, return the initial amount you invested. Bonds are like contracts, promises traded in financial markets. They come in various forms, each with its unique terms, such as the interest rate, called the coupon rate, and the maturity date, which is when the loan is repaid in full. For example, when you purchase a government bond, you're effectively lending money to the government. In return, they agree to pay you interest periodically and return your principal when the bond matures. These regular interest payments provide a predictable income stream, making bonds popular with investors seeking stability and income over the roller coaster ride of stock dividends. The bond market is diverse, with each type of bond offering different characteristics, risks, and rewards. Government bonds. Known for their safety, government bonds are issued by national governments to fund their operations. In the US, these are called treasuries and are classified based on maturity. Treasury bonds for longer terms, treasury notes for mid-terms, and treasury bills for shorter terms. Government bonds are seen as stable investments, especially in uncertain times. And while they tend to offer lower returns, they're backed by the credit and trust of the government itself. Corporate bonds. Issued by companies, corporate bonds offer higher returns than government bonds, reflecting the additional risk that comes with lending money to businesses. Corporates range from investment-grade bonds, which are issued by financially stable companies and offer lower yields, to high-yield or junk bonds, which are issued by companies with weaker credit ratings and provide higher yields to offset the greater risk. Investors seeking higher income may be drawn to corporate bonds, especially those with a tolerance for risk and an interest in analyzing company health. Municipal bonds. Municipal bonds, or munis, are issued by states, cities, and other local governments to fund public projects. They're attractive for their tax advantages, as interest income from munis is often exempt from federal and sometimes state and local taxes. This tax benefit makes them ideal for investors in higher tax brackets who want a secure and tax-efficient way to earn interest while supporting community development. Each type of bond plays a specific role in a portfolio, providing investors with options that range from the stability of government bonds to the high-yield potential of corporate bonds, all contributing to a diversified and balanced investment strategy. One of the fundamental dynamics in bond investing is the relationship between bond prices and interest rates. This relationship is inversely proportional. When interest rates rise, bond prices tend to fall, and vice versa. Here's why this happens. If you hold an older bond with a lower interest rate, it becomes less attractive to new buyers when newer bonds with higher rates become available. As a result, the value of your bond decreases. This inverse relationship presents both challenges and opportunities. Rising interest rates can decrease the value of your existing bonds, which can be problematic if you need to sell them before they mature. Conversely, when interest rates fall, the market value of your bonds increases, which can be advantageous for those holding bonds with higher coupon rates. For this reason, understanding and managing interest rate risk is crucial in bond investing. Constructing a well-rounded bond portfolio involves combining different types of bonds and maturities to balance risk and return. Here are some essential strategies for building a bond portfolio. Diversification. Just as with stocks, diversifying within your bond investments helps to spread risk. By including government, corporate, and municipal bonds, you can create a balanced portfolio that mitigates the impact of any single bond type underperforming. Diversifying across sectors and credit ratings also adds layers of safety and potential income. Laddering. A popular strategy, laddering involves purchasing bonds with different maturity dates. Imagine building a ladder where each rung represents a bond maturing at a different time. As each bond matures, you can reinvest the principal in a new bond at prevailing rates. This approach provides liquidity, as you regularly receive principal back, and allows you to capture higher interest rates if they rise over time. Quality focus. Bonds are rated for quality, indicating the issuer's ability to meet its obligations. Higher-rated bonds, like AAA, are safer, but usually offer lower returns. In contrast, lower-rated bonds, often called junk bonds, provide higher returns, but come with higher risk. By balancing high-quality bonds with some higher-yielding options, investors can enhance income without taking on excessive risk. Duration management. Duration measures a bond's sensitivity to interest rate changes. Short-duration bonds are less affected by rate fluctuations, making them suitable in rising rate environments. Longer-duration bonds are more sensitive but offer the potential for higher returns when rates are falling. By including bonds with various durations, investors can manage interest rate risks more effectively. These strategies allow investors to create a tailored bond portfolio, enhancing stability, income, and growth potential, while also adapting to changes in economic conditions and interest rates. Bonds play a unique and essential role in a diversified portfolio. Think of a portfolio as a symphony, where each asset class contributes its unique sound. Stocks provide growth potential, while bonds add harmony and balance, softening the portfolio's overall risk. Bonds are less volatile than stocks, which makes them ideal for reducing the impact of market downturns. During turbulent stock market periods, bond prices often rise as investors seek safer assets. This negative correlation provides a hedge, helping to smooth returns and provide a cushion against equity losses. Bonds are especially valuable for income-focused investors, like retirees, who benefit from the regular interest payments that bonds provide. Bonds not only provide safety, but also enhance the overall portfolio's long-term performance. For instance, reinvesting bond interest payments allows you to benefit from compounding, which contributes to the portfolio's growth over time. By balancing stocks' growth potential with bonds' stability, investors can achieve a portfolio that performs well across different market environments. Every bond carries a level of credit risk, which is the risk that the issuer may default on their obligations. To help investors assess this risk, rating agencies provide bond ratings, a quick snapshot of the issuer's creditworthiness. Bonds with high ratings, like AAA, are considered safe, while lower-rated bonds, known as junk bonds, are riskier, but offer higher returns. For those investing in lower-rated bonds, understanding the issuer's financial health is crucial. A bond's credit rating can change over time, reflecting shifts in the issuer's condition or economic environment. By regularly evaluating ratings and staying updated on market conditions, investors can manage credit risk effectively, balancing the quest for returns with the need for stability. Interest rate risk poses one of the greatest challenges in bond investing, but bond laddering offers a way to mitigate this risk. In a laddering strategy, investors purchase bonds with staggered maturities, some short-term, some medium, and some long-term. As each bond matures, the investor can reinvest the principal at the current interest rate. This approach provides both liquidity and the opportunity to capture rising rates over time, while also balancing exposure to rate fluctuations. Bond laddering aligns well with the principle of not timing the market, as it allows investors to navigate a range of interest rate environments with confidence. In the world of investing, bonds provide more than just stability. They offer a critical foundation that can balance and support an entire portfolio. By diversifying across bond types, managing interest rate risks, and understanding credit ratings, investors can craft a bond portfolio that aligns with their financial goals, risk tolerance, and time horizon. Whether through the steady income from government bonds, the higher yields of corporate bonds, or the tax advantages of municipal bonds, bonds add value and resilience to a diversified investment strategy. Like a well-tuned instrument in an orchestra, bonds harmonize with other assets, helping to create a balanced and resilient portfolio capable of withstanding economic cycles. As you embark on or continue your bond investing journey, remember that understanding the intricacies of bonds unlocks a world of financial stability, growth, and income that can serve as a bedrock for building wealth.